I would point out on that there's very good reason to be suspicious about the reported unemployment rate. I know my friend E.J. Antoni is going to go get that squared away at the BLS, but I would highlight that if you look at a chart of consumer delinquencies and the unemployment rate, the two lines are usually indistinguishable. And we've now had an environment where consumer delinquencies are back to where they were, in some cases since the GFC, not even COVID, but, like auto loans and credit cards, all the way back to the financial crisis. And the unemployment rate obviously is still pretty much flat on the mat. So there's something that is different, and it might have to do less with the actual employment environment so much as the quality of the data that is being produced from the BLS. So I hate to jump on that bandwagon, but I will say I have been a skeptic about the quality of the payroll data for decades. So I'm not just joining in on the administration's chorus here. I'm not banging their drum. This is something that I've been tracking because I have the unpleasant task every month of digging through all this data and, can just see that it doesn't add up. And then when you look at things like corporate tax receipts going negative year on year and the idea that employment is tight, it's like this just doesn't add up. The number one input into hiring decisions is profits. And if your profits are contracting, you're not running out hiring more people. You're trying to cut hours and headcounts and salvage as much as you can. Well, I think we've already seen a big increase in layoff announcements. If you look at the Challenger Gray data, they show you've got a pretty significant increase in layoff announcements over the last year. And we obviously have seen a lot in tech in particular. And you've seen massive restaurant bankruptcies, retail bankruptcies.
Yeah.
But I would think the more likely catalyst for a sharply higher unemployment rate would be people running back into the labor force. You had a lot of people who basically went to the sidelines because they could afford to just, spend their COVID stimulus money, and they were getting all kinds of, some people were enjoying, fraudulent welfare pay, Medicaid and all that stuff that they're now cracking down on, which may force a lot of people to get back into the workforce. That, you have to kind of couch that against the immigration side of it, which is going to cut the other way. But I think that could be another factor, because you did see a lot of people, and especially working age young men, who dropped out of the labor force, who could very well come back, and that would inflate the unemployment numbers. But I think while they try to get a new structure in place for how they're going to do the monthly employment report, who knows what's going to happen. I mean, I saw an article the other day that EJ was talking about maybe only doing a quarterly release, and they were going to look at, how the data is compiled. And so there may be a lot of dramatic changes in the picture that make people have to focus elsewhere, which would probably be a healthy thing. Like if people focused more on the weekly unemployment claims data and things like the hiring outlook expressed by small businesses in the monthly NFIB survey, rather than hanging myopically on this one payroll report in the first Friday of every month, only to find out the next month that it was completely the opposite of what they were told on the initial number. Wouldn't you think? I mean, I have to imagine that you would probably have a side-by-side type of situation where you have an AI-built model like you're talking about that tracks the various inputs and gathers all the data that the Fed would normally consume and presents its trajectory of where policy rates should be. And then they sit around the table, the FOMC, and they analyze that. And then they debate, well, maybe that input really shouldn't be weighted as high or whatever. Or maybe AI isn't aware that we've got this policy change coming, or whatever it is that's unique that they want to apply to it. But to at least start with a firm quantitative basis, rather than it seems like they just kind of spitballing, but they're also spitballing on the basis of data that is clearly really unreliable. And I think to your broader question of, why do the financial markets continue to obsess about this rather than looking at trueflation and these other measures? And I think it's just become habit. Like, could you imagine if on Friday or whatever the first Friday of September is, payroll employment came out and no one cared about it? Like, it's just hard to imagine. Everyone trades these numbers. And so we're kind of forced to pay respect to data that otherwise deserves zero respect. So it's going to take a while, I think, to untrain people who have been looking at that for so long. But I think the clear problems with the data that are evident in the dramatic revisions we've seen are starting to raise some skepticism around, well, okay, if we can't trust that, why are we expecting the government can calculate CPI any better? And we know they can't. We know that the CPI is artificially suppressed on purpose because COLA and everything else are linked to inflation. So they want to keep it as low as possible, not to mention tips, so there's a incentive for the government to lowball the inflation numbers, but I digress. So I think it's going to take a little while to untrain investors from that, but I think you're totally right that we're headed to a future where most of this will be model driven. I think there is even an outfit out there that produces an AI estimate for payrolls every month. I haven't looked at that recently, but I know at the beginning of the year, people were referencing this kind of AI forecast for payrolls, and it seemed to be more accurate, not surprisingly, than the BLS data. My main concern is a highly levered economy being able to accelerate its growth at a time when interest rates are going to remain stubbornly high, and that the debt service is going to be rolling, at higher levels, and that's going to be a drag on the ability to spend, basically. So you're looking at that on the one side, and then you're trying to look at income growth created as a result of all of these pro-growth policies from not just the corporations themselves, who will be generating more income because they have deregulation and accelerated depreciation and blah, 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 but also the consumers who, in theory, are employed by those corporations who are suddenly enjoying stronger profits. So it's a question of that. In my view, I like to oversimplify everything, is the tug of war between how much of a drag are higher rates going to be relative to how much of a boost is the increased income going to be. Is the increased income going to be sufficient to offset the stubbornly high debt service issues? And I don't think you can just answer that in one sweeping generalization about the economy. I mean, I think it's really, I hate to say it, but it's going to depend. Certain sectors, certain industries, that maybe not as levered, but also benefit from the pro-growth policies will do well. And conversely, the ones who are massively levered, but don't have as much benefit upside from some of these policies will really underperform. So I think for people who are stock pickers, this is probably going to be a really interesting time. I think what I'm basically saying is we're the era of passive investing, where you just threw your money into some, S&P ETF, and you could, close your eyes and you'd be up 15% a year. I think that's going to be over, and you're actually going to have to get back to the business of analyzing specific companies and industries and understanding the push-pull between the interest rates and the pro-growth policies and picking out specific winners and losers. So maybe we'll actually get to a place where it's all about active investing and absolute performance rather than this passive game, which frankly I would welcome. And I think there are a lot of people in this business who would welcome it as well. You're seeing this already. I mean, for the last 2 years, we've seen a parade of corporate bankruptcies. At the same time, the Mag 7 are soaring. So there's clearly some companies and industries that just cannot survive at higher interest rates. And there are others who are making so much money that the higher borrowing costs really aren't a factor for them. So it really depends. And then you've got the same situation in the consumer space, where you have, again, and we've talked about it endlessly, that the group of higher end constituents who are just bulletproof, and then the people who are really struggling. And I would say that the average American has been in recession and is in recession, and it's just belied by these other, the higher end. And the same is probably true for the corporate sector, as judged by the decline in corporate tax receipts. So I think that, it's just a question of how people choose to look at this. They tend to glom onto the headline numbers and hide, like I like to say, in the cozy bosom of averages, because that makes everyone feel good about the situation. But those averages increasingly reflect nobody. There's either the companies that are doing great or they're bankrupt. And the same is really true for consumers increasingly. Well, I mean, it has been a concern, and I will say something very optimistic and hopeful to the shock and delight of your audience, and that is, I think that we're now at the point where the pendulum has hit its apogee, and we are going to swing back the other way. And I think that's precisely what a lot of these deglobalization policies are designed to accomplish, without getting on a political soapbox. And I don't think it's a political thing. For a long time, we basically exported the plebeian task of manufacturing basic stuff to the rest of the world, or we had immigrant workers do it here, and we enjoyed a very low cost of goods as a consequence. So now the trade-off is going to be that the price of goods is going to go up, but we'll have a stronger, more even consumer segment, rather than it being bifurcated with a high end and low end. Will kind of strengthen the lower and middle class and narrow that extreme divergence. I think that's clearly the objective of a lot of these policies, things like no tax on tips and the onshoring of production. And so I'm hopeful that we've hit the extremes, and that chart that you just showed is at the nadir, and that we're going to start to move back higher. It's very natural. And this is what happens in market psychology too. When things keep going in one direction for so long, to extrapolate that infinitely into the future. But it's usually at that moment where everyone is convinced that it's just an unstoppable train that it's about to turn. And so I'm very hopeful. I mean, we haven't seen an administration tackle this issue yet. I mean, it's been decades over that entire span that your chart covers. No one has really expressed a concern for how much the middle class has been left behind, and addressed why, or at least in part, why they've been left behind. And I feel like they're at least making an attempt at it. And that gives me some optimism that maybe now they've pulled the curtain and everyone sees this as a major issue. And then you get people like this lunatic who's running for mayor in New York, who's crazy, and he's probably a communist, but he's touched a nerve because he's talking about exactly this. No one can afford to buy a home or apartment and live in New York. And so it's just reached a point of being completely untenable. My hope is that the reaction isn't to go the communist route. We'll see, but that the reaction is to go more the route that the administration is trying to blaze. But time will tell. In fact, we'll probably find out before the year ends. I'm in the same assets. I am, again, at the margin, trying to shift more overweight the gold miners relative to the bullion itself, but I think both are going to perform very nicely. And then I got to figure out what I'm going to do when my T-bills mature. I guess I'll just start putting more of that toward miners. And I think also in the energy space, because as this AI boom to me is more of an energy story than an AI story. So I think that's one aspect of it that people just aren't really giving proper due. And I think we did have this conversation, and I was talking about the chart of oil prices relative to the S&P. And, they're at low extremes, pretty much the all-time record low. So there are a lot of opportunities there. If you genuinely believe that AI is future, you probably want to have a healthy exposure to the energy required to power it. And if what was happened in the Middle East is any indication, we may not even see a dramatic decline. We probably will get some sell-off, but it may not even be as dramatic as one might think. So we'll see.